Revenue or sales journals are pretty straightforward. They record transactions relating to the sales of goods and services of a company. And probably the most important thing to keep in mind is whether those sales are for cash or they are made on credit. Let's do a couple of examples. In the first example, Agrimac is a farming operation that sells citrus fruits. In the month of January of the current year, they sold $5 million worth of fruit on a cash on delivery basis to customers. What would the journal entries be for that transaction? Firstly, there'll be a debit to the bank and cash in the balance sheet because the bank account has gone up, and that would be a debit of $5 million. There would also be a credit to the revenue or sales figure in the income statement to show the income that has been generated from those sales of $5 million. Those would be the debits and credits processed on that transaction. If you had to reflect that as a journal, if you had to see that journal reflected in the T accounts in General Ledger, you would see a debit of $5 million in the bank and cash T account and a credit of $5 million in the revenue T account. If we had to do another example, let's say Agrimac sold $10 million worth of fruit, but this time they gave customers 30 days worth of credit. What would the journal entries processed be? Well, firstly, they would debit accounts receivable. They have sold something, but they are owed the money for it. They'll only receive the money later. So debiting accounts receivable in the balance sheet increases how much they are owed. It shows an asset or receivable. The credit would go to revenue or sales in the income statement, and that would be an equal amount of $10 million. How would this transaction be reflected in the T accounts? If you had to see the journal reflected in the T accounts in GL, you would see a debit of $10 million in the trade or accounts receivable T account and a credit of $10 million in the revenue T account.